Hello everyone, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this video, I'm going to look at some YouTube subscriber requests to look at some of the more prominent Chinese companies. And of course, what I'm going to be looking at here are Chinese companies that are ADRs, or American Depository Receipts, that trade on the New York Stock Exchange. I would just like to add here, or just point out, that I'm not crazy about investing in international companies, mainly because of exchange rates and, whether you can trust the reporting, etc. But with these ADRs, they have to meet the standards of either the NASDAQ or the New York Stock Exchange, the accounting standards. So I feel a lot more comfortable when I'm looking at these companies. So I'm going to look at a group of pretty popular Chinese-based companies right here. I want to point something out. I'm looking mostly at growth stocks. These are not dividend stocks. These are growth stocks. They all have relatively high PE ratios if you look at it from this perspective, but they also have very high earnings growth rates, and their long-term 3 to 5 year earnings growth rates are also very attractive, except I apologize if I'm mispronouncing these. Yiren Limited only has just under 10% growth, but it's available at a very, very low PE, and we'll look at that a little later. So let's get into these companies and look at them. And another thing I want to point out, really the exercise I'm going through here is to determine whether these stocks are research worthy or not. I know very, very little about these companies, so I'm going to start with the first step in my research process is always to look at FastGraphs and see if I have valuations that make any economic sense. So I call this a tool to think with, and I'm going to look at the historical fundamentals and try to learn as much as I can about how well the companies have performed as businesses in the past, and then look at how the market has valued them, and then look at whether or not I think there's any attractive enough value today for me to go into the research. Now, when I start digging into the research, I'm going to look at, I subscribe to research services. I'm usually going to start at the company's website, or I'm going to go into a site like Seeking Alpha, and I'm going to look for articles that were written, etc. But at this point, we're just going to look at the company. So let's look at Autohome first, which essentially is a Chinese automotive purchasing company, I'm going to call it. It has a $9 billion market cap, no debt. It currently trades at a PE of 24. Its normal PE has been 25.7. And what that simply means is this is a valuation reference. This blue line is a PE of 25.7. So when I look here, I see back here in 2014 and 15, it traded at 35 and 40 PEs. And then for 2016 and 17, it traded at 15, 16 PEs. But on average, it's traded somewhere around a 20, 25 PE. The company has grown at a much faster rate, at over 40% a year. That's what the PE, or the multiple of this orange line. This is multiplying the company's operating earnings. So their historical growth has been 41%. So now let's go down and let's look at forecasting growth. Because like I always say, I can learn from the past, but I can't buy the past. I can only buy the future. Now, it's reasonably well followed. There are 7 analysts reporting for this fiscal year and 9 analysts reporting for next fiscal year. And then it drops down to 5, but they're looking for 22.7% growth. So in this forecasting calculator, I'm essentially putting a fair value, a future fair value equal to the company's growth rate. Or what I've got here is a PE of 22.7 on this orange line, as you can see right here. Now, the company got overvalued. We've had a reversion to the mean. It's come back into what I would call my valuation corridor here, which is these 4 orange lines. Obviously, if it's within these 3 lines here, the first 2, top and bottom, light colored one and the dark colored one, that's kind of the sweet spot in valuation. If we get it below, like it was back here, where it actually dips into the blue lines on an undervaluation, that's a real sweet spot. And I would say this stock is very attractively valued right now based on earnings. If I was looking out 2 to 3 years, I could make, I stand to make over 20% annualized rate of returns, assuming these estimates turn out to be reasonably correct, and assuming the stock trades at like a 22. In this case, you'd actually have a minor PE contraction from a current blended PE of 24 down to a PE of 22, but this would be a very attractive investment. If I look out a little longer term, there are only 3 analysts, but they forecast 26.7%, a little higher 3 to 5 year growth. Once again, you could get double digit, even up into the 30% annualized rates of return if the stock grew at this rate and traded at a higher PE of 26. So these are what-if scenarios. The point is there's a lot of growth forecast for this company. Valuation is attractive right now. It could be a great long-term investment. At this point, I would dub this one as being worthy of spending the additional time to research the stock. I'm going to look at EBITDA real quick and look at its normal price to EBITDA has been about 23. It's forecast to grow EBITDA at around 27% going forward. So whether I'm looking at earnings or EBITDA, this stock looks attractive, and this would be a case of the market has provided an opportunity that wasn't there just, in June of 2018. The stock was way overvalued. So that's ATHM, or Auto Home. Now, the next one I'm going to look at is Alibaba, and I've go ahead and I'm going to keep EBITDA up here since I'm already there. This company's A+ rated, has a $440 billion market cap. And one thing you can do, I can go into my external sources here, go into the Wall Street Journal, for those not familiar with these companies. And again, I'm not real familiar with these Chinese names. This is essentially, I guess you would say, a Chinese version perhaps of Amazon. It's obviously a well-run company. Its EBITDA growth has been terrific at 35%. If you look at it from a standpoint of forecast growth, it's forecast to grow at around 29%. It has a decent analyst scorecard, but not perfect, as we saw. I forgot to show you that on Auto Home. Auto Home had almost a perfect scorecard, but this is for EBITDA. Let's go ahead and look at back to adjusted operating earnings and look at Alibaba from that point of view. The earnings growth has been 28%. Its normal PE has been about 33. It's in a fair valuation range now. Company's forecast to grow at 27%. So these would be very attractive returns going forward, even if we saw some PE contraction, going from a current blended PE of 31 down to a PE of 27, you could still make 25% annualized rates of return, 16% annualized out for the next couple of years. There is an expectation of a real surge in growth in 2020, 21, and 22. This would be the kind of thing that I'd really want to be trying to validate if I was, deciding to look at this further, but I would call this company research worthy at this point. It's a company that's worth looking at further. If I go ahead and go on, I'm doing these in alphabetical order here. If I go down and look at Baidu, which is kind of the, Chinese version of Google, they had a tremendous surge in earnings growth in 2015. I validated that. It is a correct number. If I look at it from a standpoint of EBITDA, I get a little more benign. I still get a nice graph here where EBITDA growth has been very high at over 25%, but the normal price to EBITDA is completely wacky. So I'm going to ignore that. I'm going to go down here, and what I'm going to try to do is come up with a number that makes more sense. So I'm going to go into my normal multiple graph here and try to come up with a number. Now this stock trades at 200 times EBITDA. I consider that just extreme. So I'm not sure that I would actually consider this very attractive. If I look at it from a standpoint of operating cash flow, this is again another example of a company that has tremendous growth. If I look at it at operating cash flow growth of 25, a normal priced operating cash flow of 24, at a priced operating cash flow of 15, this stock would look very attractive and would give you some decent double-digit returns going out for the next couple of years. Longer term, there are 7 analysts thinking this company can grow at 16 to 18%. This would give you an opportunity to make 22 or 23% returns. The company only has 20% debt. Again, I would call this company worthy of spending some more time researching and learning more about the company if you actually want to invest your hard-earned money. JD.com is a little bit trickier for me. The company's BBB- rated. It only has 14% debt. We're looking at operating cash flow there. Let's go ahead and look at operating earnings. I think the valuation is extremely high on an operating earnings basis. If I switch this to EBITDA and went into looking at the company from a standpoint of price to EBITDA, but I want to show y'all something here because to me this is really one of the values of fast graphs, and that is when you look at these numbers here, we got a normal price to EBITDA of 57. That's the multiple of EBITDA here. But I also want you to notice these crazy growth rates. So if I shorten this graph to 4 or 5 years, now I've only got 1 year of history in the current year we're in, we start getting something around 50 times EBITDA. The stock is expected to grow EBITDA at 30%. If I just valued that at 30 times EBITDA, not this ridiculous 57 times EBITDA the company has traded at, I still have a potential to make a great deal of annualized rate of return going forward. So again, I might want to take the time to learn more about this particular Chinese company. If I look at Weibo Corporation, Again, very high multiples of price to EBITDA. So if I lengthen the graph, I want you to see these really crazy numbers here. But if you follow my mouse along here, you can see that the numbers are changing. They're slowing down dramatically. Estimated EBITDA growth is about 30%. So once again, I would use this 30 multiple as a kind of a common sense fair value. So even though it looks undervalued based on this orange line, which is almost a 60 EBITDA, I would be more comfortable valuing this stock at more like a 30 times EBITDA. If I look at it from a standpoint of adjusted operating earnings, that gives me, again, a different perspective. I've got a very high valuation that looks like it's beginning to revert to the mean. However, if I come down to forecasting, there are a relatively large group of analysts that expect this company to grow by an average of 30% over the next couple years. It's expected to have 54% growth this year, over 38% growth next year, followed by, again, north of 30% growth for the following year, and there's a lot of analysts following it. The longer term trend line growth is even better, and there are 5 analysts. This is one of the cases where I might blend the two. I might go in here and bring in the near term estimates, and the long term rates of return on this particular ADR would be extraordinary. So the valuation looks very high from this perspective, but when you look at it from the perspective of some of the other metrics, it doesn't look anywhere near as fully valued as it does just based on earnings. I already talked about the EBITDA, but if I shorten that, if I'm looking at these high multiples of EBITDA, the real key point here is not what the multiples of EBITDA or earnings are, it's the growth potential of this particular company looks, very, very strong. I'm going to look at another Chinese company here, a $9.8 billion with 3% debt, and this is 58.com. I'm going to look at it from a standpoint of numerous metrics. This is EBITDA. Let's start with adjusted operating earnings. Again, this stock looks very expensive on this basis. I'm going to go ahead and lengthen the graph here. It looks like it's a very highly valued stock. However, there are a lot of analysts following this company that expect 25+% growth over the next couple years. Long term, they expect over 30% growth. With very little debt on the balance sheet, this would be one that I would be certainly motivated to want to go in here and look. And by the way, one thing I should have been showing you along with this video, these stocks are very hot. Even with these, nice returns that these companies are generating today, that's a $70 price tag. You'll notice this is 66. If I go here and point to, that's 84. So, these stocks have certainly not gone outside of what I would consider my valuation corridors at all. And then Hyundai is the slowest growing stock of this group that I looked at, but it's also one of the most interestingly valued. It has a very, very low PE. It is expected to start paying a dividend, so we might get a little dividend yield. It's expected to have a down year this year, which might explain this, but then it's expected to grow at pretty decent rates going forward. The long-term growth rate is expected about 8 or 9%. So if I was looking at normal PE multiples of even as low as 10 here, which is historically what it was, if I look at a 3 to 5 year growth rate and just value this at a 10 multiple, I could get double-digit growth. The company has no debt. It's only $1 billion market cap. The bottom line is this is really a credit supplier. It's kind of we'll call it a financing company. If you go into the Wall Street Journal here and get a quote from the Wall Street Journal, you'll see what I'm talking about. The company gives what they call access to affordable credit and investors with attractive investment opportunities through its online marketplace. Now, when I really like a company, I want to look more, and I'm going to kind of end this video by showing you this. I would go into the company's website, and fortunately, I'm using Chrome here, they will translate it from the Chinese into the English. And then you can go in here and look, more closely at the company, or you can go into sites like Seeking Alpha and start looking for things like earnings reports, and then see if there's any slides or slide presentations. The bottom line is this is going beyond what I see on FastGraphs and starting to look at these companies from a standpoint of I think they're worthy of spending the time and effort required to research them deeper. So here I might start going in and start looking at these investor presentations and try to see if I can get comfortable with the current valuations, but most importantly, whether I think these companies have growth potential going forward or not. Anyway, if you like what you saw here and like how FastGraphs gives you the opportunity to look at a company's history as well as its future, you might want to call us at the number here on the screen or email us at www.fastgraphs.com. It's been Chuck Carnevale saying thanks for watching.